October 24th, 2025, newly elected Japanese Prime Minister Sanae Takaichi gave her initial economic policy speech where she committed to, in her words, a robust stimulus package. Now, this policy shift was a blow to Japanese bonds as 40-year yields moved from 3.37% up to a high of 4.21% on January 20th. The yen, already on a slide against the dollar that began in early 2021, continued lower, bottoming on January 14th at 159 yen to the dollar. Now, the low marked a total of a 35% drop against the dollar in just 5 years. This is particularly troubling considering the dollar is lower against most other developed currencies. Of course, any threat of an economic shock in Japan has serious consequences for the United States, as Japan holds $1.2 trillion of US Treasury bonds. Now, if there's a threat that those need to be sold quickly, the problem spreads to our shores. Interestingly, the narrative has morphed recently into some expectations that the U.S. may move to support the yen. The talk was that the U.S. Treasury and the Bank of Japan did what's called a rate check on January 23rd, where both contacted currency trading desks to ask for a price in yen, implying that perhaps they were going to be a buyer. So, without actually intervening, the two governments were able to push the yen 4% higher. Now, this story in Japan appears to be far from over, as their fiscal issues don't seem to be going away anytime soon.